Let's get underway with the briefing for this morning. Obviously, big day for the markets for this week, given that we have the ECB interest rate decision later on this afternoon. We'll get into that in a bit more detail shortly, and we'll do, of course, a full, thorough run-through closer towards the time. But just a quick look in terms of some overnight news flow firstly. Just starting off with oil. Sharing with you my chart here. Let me just put a circle around this particular area. 9:30, or shortly after, a very large move to the upside in crude oil, and that's on the back of APIs, even without, we'll go through the numbers in the next few minutes, but when I first come in the morning and I see a move like that from the APIs, that's probably about as big a move as you're ever going to see on the back of an API release. As I say, usually the price movement on that number is much smaller than what you would see from the Department of Energy's release, which we'll get later on this afternoon, mainly because of the time of day more than anything. But a move from around 45.47 all the way up to 46.16. And why did this happen? Well, you've caught up probably with the news by now, but there was a phenomenal number drawdown in the API headline for crude. Now, to put this in a bit of context, the API crude number from last night was expected to show a build of 900,000. Instead, as you can see on my screen, this is what we had. We had the biggest drawdown in crude oil inventories since the beginning of 1999. So an immediate powerful move to the upside. Asia then likely reacting once they got underway. Remember, likes of the Japanese and so on, their markets tend to get underway after midnight. So when we had another push higher, kind of consolidated overnight during much of the Asian session. And this is quite also typical of what you see is when Europe starts to come in quite early from around 6 o'clock, you often start to see a little bit of digestion of that news. Sometimes Europe pushed the move a little bit further. It's a bit of a chop, but net it's held on to a large portion of those gains, and we're up 83 cents. So the drawdown was 12.08 million. As I say, the biggest drawdown since 1999. Why did this happen? Well, most are attributing this to an actual reason. It's not just come out of the blue. There's been quite severe storms experienced in the Gulf, and that's essentially led to then a ramification for facilities being able to operate. So more of the existing stockpiles being drawn down. This did also occur historically back in 2009, similar situation. That caused a plus 10 million type drawdown as well at that time. So it's not unusual. These are why crude traders, another area for you to be certainly aware of, are weather patterns. And going through hurricane season, going through El Niños, warm, cold weather patterns certainly does have some influence, certainly when it gets to the point of when there's storms and so on and so forth. So big news there, and certainly this preps us up nicely for the Department of Energy numbers we'll get later this afternoon. Do not forget that those numbers are coming out half an hour later than normal, so 4 p.m, not 3:30, which is always the case after a US bank holiday, as was on Monday. So expectations are now extremely high on the fact that the Department of Energy numbers are going to be based upon the premise that we're looking for a large drawdown in the headline. Now, people always ask me, what number do I need to focus on? Is it the output number? Is it the gasoline number? Is it the Cushing number? Well, this is a case in point where, because the headline has deviated so far from the normal price pattern, let's say, the headline is going to take the most precedence in this afternoon's report. We'll go through all the other breakdown of the other figures when that data comes out later. Moving on, a couple of other things just to be aware of from overnight that were fairly interesting. You had Chinese trade balance. The import-export numbers were actually pretty solid, so painting a fairly decent picture for China at the moment. And if you were to look at a Fed reasoning for the external headwinds, it's almost flipped on its head in terms of the US economy. From Janet Yellen and her team, If you go back a few months ago, they were panicking about Brexit, they were panicking about China. Now those two areas are actually performing quite well. In fact, it's the domestic issues that before were solid, which are now deteriorating, as we've seen from those ISM numbers. So it's kind of backtracked. The external headwinds have lessened for the Fed, but the domestic situation certainly has worsened, and hence why those expectations for a SEP hike have diminished. The other thing of note as well from overnight is the Japanese GDP. Quite unusual, because usually for GDP, for the second quarter reading, it was the final print. And as you know from a final revision, you very rarely get any deviation. But actually, it was revised up to 0.2% quarter on quarter from expected flat. And year on year was also higher than expected. So some fairly positive signs coming out of Asia from a more, statistical point of view. Just taking a look then at the main event. And so that is the ECB. Now, there's a couple of charts I want to start off with. Firstly, let me just transition my screen. So the question mark today for market participants is kind of not if, it's pretty much a certainty that the ECB will expand their QE and i.e. make their policy more accommodative at some point in the near future. The question mark is whether that is today or later on down the timeline. Now, this chart here is just showing you today's meeting is most likely opportunity for more stimulus or QE changes. So out of the 50 economists surveyed by Bloomberg at the end of August, beginning of September, so it is slightly dated by a few days, but nearly half are expecting additional ECB stimulus. This still, because of the generally low pattern of inflation, concerns about ultimately the Eurozone is going to slow from their prior projections because of Brexit, even though it hasn't been as bad as feared. Ultimately, it is going to have a bit of an effect on Europe. And as such, in addition to the fact, as we'll get onto shortly, the QE program in its current guise, the parameters, there's not many more bonds for the ECB to buy. So some are expecting changes forthcoming as soon as today. Moving on then, looking at the reasons why, for me personally, I feel as though the ECB will not make any changes today. And it's a 50-50 bet pretty much in terms of how I think the market is kind of expecting the ECB to act. But as we've just said, the fallout from Brexit has actually been more contained than possibly many had feared. Now, if you look at Mark Carney, yesterday he remained committed to his wording about there is still scope to ease. I didn't really find that too surprising. I don't think there's any reason for him to change tact from their previous commitment, but certainly UK data has been solid after the initial July dip post-Brexit. August has bounced back quite powerfully, more importantly in the service sector, but also in manufacturing. What I'm showing you here is a good barometer of risk sentiment when it comes to Europe, as we saw a few months ago, are the performance of the Stoxx 600 European banks. So the Stoxx 600, essentially a larger, broader index of European companies. You can see that defined by the red line. After the surprise Brexit vote, we've bounced back in a fairly consistent fashion. More importantly, that's the blue line. The red line is the banks. Banks are, I would say, on a sector basis, probably the most hypersensitive to sentiment. And if they're recovering quite nicely, then that's a good positive sign for the economy. Certainly, Italian banks, has their bad loan situation disappeared? Certainly not, but at least the market's attention has been diverted elsewhere, for the time being, that is. One of the other charts as well is looking at the economic data that's been coming out. Now, this is aside from what we've had in the UK. German IFO, one of the biggest numbers that comes out of Germany, and ZEW. So these are forward-looking economic indicators which are very important for investment decisions for corporations going forward and their confidence to put money to play. they actually have been fairly robust in terms of the data points that have come out. Yes, there was a dip post-Brexit, but we've started to recover already. And the Centex investor confidence, PMI manufacturing and new orders have all been fairly resilient. And in fact, stable PMIs have been in place for 6 consecutive months when you look at Europe. That then asks the question, why now should the ECB act? Why not let it play out a little bit longer to see ultimately as well what the Fed do? Now, if the Fed pull the trigger on a rate rise, maybe they might need to reevaluate if that has ramifications and equity markets start to come under pressure. But at this point in time, it's probably more opportune for them to sit on their hands. Now, there are a couple of things, though, that are to be made aware of as we go into this. And this is in regards to if they did make any changes. One of the most easiest ways for them to tweak QE policy, which I'm sure you've read by now, is increasing the QE timeline. Now, at the moment, in terms of the timeline, as you can see here, the program is set to go on until March of 2017 or into the spring. They're currently buying 80 billion euros of government bonds on a monthly basis. Now, the easiest thing for this, if you want to change the program, is just essentially change that. Let me change my screen. Change March 2017 further out down the timeline. Therefore, you're just continuing the program, buying more bonds, further 80 billions per month for another few months. Now, this does come with one big problem. As you've read in multiple stories, and you can see denoted by this chart here, is the way that the QE program works is by a system called the capital key. So depending on how big a country is, determines then by how much of the bonds that can be bought. Now, of each country, there is a limit of 33% of that country's bonds in which they can buy. But if you're looking at different countries, I think I saw a statistic as something like, let's say, Germany, you can buy 18%, whereas Cyprus is 0.15% in terms of contribution to the overall euro area. And so when it comes down to that, most of the QE, as you can see here, has been geared around Germany. The problem is that Germany is getting close to running out of the amount of bonds that can be bought. Now, there's still plenty of more bonds that can be bought, let's say, in the likes of Italy in comparison. But the problem is that there's other conditions, such as they can only buy bonds that yield above the ECB's deposit rate, which, as you know, is minus 0.4%. The problem is that yields have gone into further and further negative territory, making those eligible to purchase not available to buy. So essentially, in a nutshell, this QE program and its in current, the way it's set up, they're going to have to tweak it if they're going to push the timeline out, because otherwise, ultimately, there's not going to be anything for them to buy. Now, there's a couple of different ways in which they could do that. One of which is they could raise the issuer limit on bonds. That would be probably the most simplest. So instead of 33%, they could say they could buy up to 50%. Other methods, Credit Suisse, they've talked about the ECB would free up an extra 390 billion euros of bonds if it lowered the yield floor of which it buys bonds. I.e., if you were to just drop that minus 0.4% to lower, or you just scrapped it altogether. The only problem is, I think, if you give the market an inch, it will take a mile, and then yields are just going to keep going further negative. The other thing that Credit Suisse estimate is that ECB disregarded the capital key, as if they got rid of it, it would free up an extra 620 billion euros of bonds to buy, meaning that the program can go on for a longer period of time. That would be the most powerful option to open up the amount of bonds eligible for purchase. The only problem is that if you scrap the capital key, it basically means then that other nations like Spain or Italy who have a huge amount of, actually, if you were to drop a lot of these terms, number of bonds to buy, it would be to the disbenefit of Germany. So essentially, Italy, let's say, who's got a lot of bad debt, they would get the most helped out in that situation, and that would be to the disbenefit of Germany, who would have the least benefit. Now, you can imagine politically how the Germans are going to react to that. Now, you know the composition of how the structure of hawks and doves sits on the ECB. The pigs, the southern European nations, sit pretty much far on the left, the doves, and Germany on the far right, the hawks. And so it's going to be very difficult politically for the ECB to be able to push through any type of agreement of dropping the capital key. If you hear the capital key mentioned this afternoon or going forward, that is ultimately the biggest trading event, and that will cause the biggest, sharpest move in the markets, because that is the least likely to happen. Raising the issuer limit, extension of the timeline is probably the most likely, and so that's probably going to have the least amount of impact. But given today's 50-50 and whether they do anything or not, then either way you're probably going to see some volatility. Now, talking about this issue of politics and Germany not wanting to essentially give way in order to assist the weaker nations, well, looking at this chart here is the rotation of the governing board at the ECB Council. Now, this is important because now of the amount of members that there are that comprise of the Eurozone, not every nation has a vote at every meeting. Now, this can be important for really one reason, and that reason is this chap, Jens Weidmann, the German member. Now, he is a staunch hawk and very anti-QE. If you look at it, there are 2 times during 2016 when Weidmann is not voting in the regular council meetings, that being May and that being October. The last time the ECB, back in March of 2016, cut interest rates, introduced new long-term targeted refinancing operations, they expanded their QE program, was when Jens Weidmann did not have a vote at the time. I think this was back previously when they did it. Well, October, again, is when he does not have a vote. So he does vote this time, he does not vote next month. Could it be that the ECB simply just delay this month and then go back to revisiting this timeline extension of QE in October when he is not there to defend it? Now, how it works is that he still attends the meeting, so he can still speak, but he just does not have a vote, so he can be outvoted. Intimidation tactics at play, I'm sure, when they all sit round the round table, but no vote. Going back to the other things as well, just to be aware of for the ECB meeting later on today, they are releasing their staff projections. Now, these are normally quite important, but I feel as though these are probably going to be lesser so this time round, and that's because in terms of their GDP and inflation, likelihood is they're both going to see some minor revisions, and that's chiefly down to the UK's vote to leave the EU. If I see today the ECB forecasting that GDP in the Eurozone is going to slow, that comes as absolutely no surprise. It's only going to be interesting if they revise it, let's say, sharply lower, or if they surprise and leave it unchanged and say that Brexit really is a non-issue for Europe. That would be a hawkish scenario. And then finally, there are some other looming political risks, as noted here by the FT. At this point in time, although the UK has outperformed in a couple of economic metrics, such as manufacturing and services, ultimately, we've not even triggered Article 50. We do not even know yet what our deal with Europe and the single market will be. So ultimately, there could be further pain down the line. That's for the UK. When it comes to France and Germany, both face national elections next year. When it comes to Italy, that's probably the most politically uncertain, as Renzi, the PM, has said he would resign if he loses a referendum or constitutional reform scheduled for November or December. See, if you put it in this terms for political situation in Europe at the moment, in the UK, we don't know whether we're going to remain in the Eurozone. In Spain, the PM just lost a vote of confidence just the other week. In Italy, Renzi is facing a David Cameron-esque type situation where it's do or die in a referendum and constitutional reform vote. And in Austria, they only just about pipped a far-right nationalist party getting in their most recent elections. And then you've got elections in France and Germany next year where Angela Merkel has been getting hammered in the regional elections. This is all things that the ECB will have to contemplate going forward in the next 12-month horizon. Okay, quick look then at the calendar. Yeah, Michael just saying in the chat, Spain's stock market on fire again this morning, up 1%. Quite rightly so. Spain, actually, the IBEX performing fairly well. Again, a lot to be said for the ECB's accommodation, and not just the ECB, but globally, which is why, as well, the Fed decision is going to be quite important later on this month. Taking a look at the calendar, though, for today, there is absolutely nothing coming out this morning. My word of advice would be, I have a screen where I can see everyone's trades. I can see as soon as you click the button what trade you're in. I would hope that I see very little activity on that screen on a morning like this, when there's absolutely nothing going on and there's a big event happening in the afternoon, of which ultimately is going to throw up at least a few opportunities potentially for you to trade. What you don't want to do is be in a negative situation before the event even begins. Therefore, the best opportunity may arise during the ECB press conference and you're not even able to trade it. Don't forget, with the ECB, it's a two-pronged affair. You get the interest rate decision at 12:45. We're not expecting any change on rates. If we did see a change on rates, that would be a monumental surprise, and you would see a very large impact in the market. So we're not expecting anything at 12:45. 1:30, when Draghi speaks, which typically lasts for about 1 hour, that's when you need to be switched on, zoned in, listening to the words he's saying to really identify what it is that he's conveying. Otherwise, for the rest of this afternoon, then, you've got the weekly jobs data coming out of the US as per normal. You've got the oil inventory numbers, as I said, slightly later, 4 o'clock rather than 3:30. Again, that will be interesting, given the APIs we had last night with the big drawdown. And, of course, Draghi is the main event. A couple of questions I see in the chat. I'll pick those up once we finish the briefing. But going to finish with that. Again, we'll do a more thorough run-through for the ECB and how to trade it about an hour before the actual event. So enjoy your morning. We did send out some research this morning for the ECB, so please do take a read and put any questions in the chat, and happy to talk it over. Have a good day.